Today I wanted to dig into interest rates. You know, we are at record low interest rates, and there is immense power in interest rates related to affordability. Yes, Silicon Valley, Bay Area housing prices are high, but these interest rates are part of what's fueling this market. Let's look in the computer, get some charts, let's talk about some data and several reasons why this market continues to be strong. Affordability significantly worsened over time. Well, let's take a look at this chart and let's discuss interest rates and prices a little bit more detail. We all can agree that yes, Silicon Valley, Santa Clara County home prices are expensive and very high and have been appreciating. On this chart, you see that is the blue line, single family home prices median for Santa Clara County. And look at that big increase that we saw in 2021. But what I want to point out are these interest rates in the red line and how they've just continued to decrease significantly since middle of 2018 and down with a little blip early on, but rates are still excellent, near record lows. So there is a huge advantage to these lower interest rates on affordability, which is why so many people are jumping into the market today. But what does that actually mean? How does that compare to before? Well, I've pulled some data from just key moments. I pulled July in most cases because July lots of times is peak prices. So I wanted to get a feel for if, what's motivating those buyers to jump in when the prices are going up and up. Right? So basically, I took a snapshot of July 2000 where the median home price was $547. Did you know that at that time, the interest rate was 8.22%? What? So that equated to a $3,286 principal and interest payment. Now, I think we all can agree that incomes in 2000 versus 2021 are quite different. And I have not adjusted any of these prices for inflation or increase in salaries generally in this area. So as you can tell, that felt a lot bigger than $3,200 that does today back in 2000. Now take a note of this column here. You see from 2000 July to July 2006, prices increased 46%. But interest rates actually went down a little bit. So the principal and interest payment only increased 26%. That's a huge difference and a benefit and power of the interest rate, right? So if we continue to follow that, you'll see some interesting changes. For example, here in 2012, the market increased 24% from the year before, and the year after another 26%. If you look at an increase of 24% in prices, but the payment, it stayed flat. Look at that. 24% price increase to 0% increase in principal and interest. Again, look at that interest rate change. Now, to the contrary, prices went up 26% and the interest rate went up. So now all of a sudden the payment was 78% more than just 2 years prior. Ouch. And you know what's interesting is if you look at the prices, that's where we see this change here. There was a very slight appreciation in 2009 to 2012, and then the slope of the curve changed in 2013. So I think that's the biggest difference that we're noticing right there from 2012 to 2014 is that slope change really affected the affordability, and interest rates went in the wrong direction, right? So if we continue to look at this, interest rates have held pretty steady except for the recent in July 2021. If you look from July 2014, which we were just talking about, to today, the price is 2 times, right? But look at the payment. The payment was $4,600 to $5,600. Definitely not 2 times, right? So it's much more affordable today than it was back then relative to the price. July 2006, the price was $800,000. And if you double that plus a little, you get to today's median in July of 2021 of over 1.6. So look at the price or the payment difference, $4,147 to $5,617. Now that is not as significant of a jump as it feels based on the price. It's definitely not 2x, right? So that again is a power of interest rates from 6.78 down to 3% basically. So as the prices are softening a little bit for the fall and interest rates are continuing to go down, today they're at 2.75%, it is getting more affordable. The payments are actually going down because of prices softening about 2%, but also interest rates softening. You get a benefit of about a 5% decrease in the cost of a principal and interest. So I hope you understand the trade-offs there. And I want you to be able to download and calculate some of these numbers. If you download my home buyer guide, there is a page in there that talks about how much you can afford, and it gives you an easy way to calculate the interest rate. And if you don't have a mortgage calculator or loan calculator, for example, this is a great way to do it a factor. So I'll put a link to the home buyer guide below that you can download. Talking about this $5,300 or $5,600 median home price, who can really afford this? That's $5,000 a month for your living expenses. I get this question all the time, like from people who've been in this area for a while. How can people possibly afford these prices? I've got this interesting chart that talks about, and this is data from 2015, okay, talks about high income earners. So those who make $150,000 or more. In 2015, that was 27% of the Bay Area household incomes were over $150,000. I think most people will agree salaries have gone up, and most people are probably making even more than 2015 if you've been here that long. So this number might actually be larger at this point in time, which is pretty crazy, right? So if that many people live in this area, that section of people can definitely afford to buy properties in this area, because I did some math. At $5,000 a month of payments, and $150,000 of income, that is 40% of your income going to your housing costs. Now, banks will qualify you for that. They qualify typically from 40 to 45%. Some of them cap out at 43%. Obviously, if you don't need to put that much into housing, even better, right? But that's what keeps the market going, is there are high income earners in this area who can afford this. So let's again look at the Santa Clara County chart, because the other thing that's really fueling this besides the interest rate is this low inventory and higher supply. So zoom in here to this green and yellow section. So here we are zooming in on the recent Santa Clara County market chart. The yellow line is inventory, the green line is the number of sales. So as you can see, if you draw that peak of sales, we have not had that many months consistently above that range in many years. So demand is really up and sales are really happening. And the inventory, this yellow line, is very low. So we are still experiencing a very offset supply and demand market. And even though people are leaving the area, there are more people buying and jumping in, I think, because of those interest rates. So if you don't own your current primary residence, why not? Because it's really, there's some tax advantages, there's equity potentially advantages. Definitely, if you can't afford that median home price or you don't make over $150,000, you can start with something smaller, like a townhome or a condo. Get in the market when and where you can. Maybe you buy further south to get something more affordable in Blossom Valley, for example. So if you're considering that, I want you to next watch Renting versus Buying, the Pros and Cons, things to do before buying a house. Thanks for watching.